Welcome to Rural Classroom Live. I'm Albert Liu, here again, as always, with Rick Rule. Rick, how are you doing today?
I'm doing very well, Albert. Thank you for causing this to occur. I enjoy these sessions.
Me as well. We'll be here for the next hour or so, hearing from Rick and then taking your questions. We do this every week at ruralclassroom.com, where we have Rick and a number of contributors contributing content, as well as over 10,000 active members who are investors in the natural resource space. Rick, let's start with some comments from you. What are you thinking about these days?
I was thinking about what I was going to say today, Albert, and I want to lead off by saying I think we are finally into that long-awaited event, which is to say a gold bull market. Now, I'll talk more in a minute about gold markets, but thinking about that reminded me years ago, in the middle part of the decade of the 1980s, driving through Midland, Texas, after the oil bull market had collapsed, and there was a vicious bear market. And I remember seeing a bumper sticker on a car in Midland, Texas. And the bumper sticker said, "God, please give me one more bull market. I promise not to waste this one." And I want folks to think about that, because I think we're in a bull market now. And don't waste it. There's a whole bunch of ways you can waste it. And we're going to talk about that a little bit. But I want to talk about the anatomy of a gold bull market. And I want to use the visual of a circus master's whip. Visualize the circus master's whip. The front of the whip, which moves first, is the metal itself. And I would argue that the metal has been in a primary bull market for some time. One would argue going as back as 2000, but I don't think it has to go back that far. When the momentum is established by gold, that does two things. It attracts other people to the narrative, but it also increases the biggest and the best producers' margins. We've talked about this at the classroom before. In the beginning, not much happens, perhaps because the cost of producing gold might go up as fast as the gold price does. But over time, the increase in the gold price allows producers' margins to expand. We saw that in 2024 with not as much price follow through as we would have expected. But after a couple of quarters of above average earnings, what you see is that the biggest and the best of the gold stocks begins to move. And we've certainly seen that with conference exhibitors like Wheaton Precious, Franco-Nevada, and Agnico Eagle. Those stocks, big stocks, have seen just absolute blowout earnings. And the consequence of that is that those stocks have screamed. That has happened in all the previous precious metals bull markets that I've inhabited. What happens is that valuation discrepancies begin to appear. We talked about this in the M&A the M&A discussion that we had last week, but valuation discrepancies occur. And one of two things happens there. Either value conscious investors, people like myself, frankly, begin to look for better relative value lower in the quality chain, or the big companies with higher share prices take over the smaller companies with lower valuations. And this proceeds all the way down the chain until the end, the penny dreadfuls, which are the tail of the circus master's whip. They move last, but they move the furthest, and when they move the fastest. Rather than pay attention to the whole bull market, I think the thing that you need to do is identify who and what you are. Are you an investor? Are you risk averse? If so, just capturing the beta in a gold bull market is sufficient. If you study prior bull markets, what you see is that the market itself can generate between 250 and 500% returns, peak to trough. If you underperform that a little bit by owning the biggest and the best companies and de-risking it, you've done fine. If you were the self-actualized kind of investor who pays attention to the Rural Classroom, you need to think about the juxtaposition between risk and reward. And again, I want to give you a visualization tool. For those of you who are as old as I, at least, think about a yardstick at a fabric store or at a lumber yard. Think about the left side of the yardstick, 0, as representing very low return and very low risk. And think about 36 inches as representing very high return and very high risk. What most speculators want to do is they want to bend the yardstick, which is to say they want low risk and high return. The problem is that if you do that, you break the yardstick. You end up with nothing. And I want you to visualize for yourself the juxtaposition between risk and reward, because the real risk in this market is going to come from your own mistakes, not from the market itself. I want you to think too, in the discussion about the bull market, about the fact that it won't be consistent. It won't be stair steps to heaven. It will be more like a rodeo, higher highs to be sure and higher lows to be sure, until it's run its course. A couple things about that you need to know. In my formative years, 1970 to 1980, my first bull market, rip-roaring bull market, if ever there was one, in the middle of that bull market in 1975, the gold price fell by half, and the gold stocks fell by more than that. A 50% decline in the gold price didn't derail the bull market, but it did derail it for some participants. So understand that a break in the gold price, even a psychotic break in the gold price, could occur as a consequence of dramatically higher near-term interest rates. That will occur. In 1970, we had dramatically higher interest rates, which cratered the gold price. It cratered the bond market, it cratered the stock market, and it threatened to crater the real estate market. Congress and the Fed lost their nerve, backed off on interest rates, and then it was off to the races with gold. Specifically, at the beginning of 1975, the gold price is at $200 an ounce, having risen there from $35 an ounce. In the course of the year 1975, the gold price fell from $200 to $100. That 50% decline shook out a lot of the faithful, or so-called faithful. Those who weren't shaken out, or those who added to their positions, saw the gold price in 5.5 short years go from $100 an ounce, to $850 an ounce. So there's a lot of lessons here. One lesson is that there will be a lot of volatility and there will be a lot of opportunities to be shaken out. The next thing is that if you right size your participation in the market, if you have money invested that is consistent with your psychological and financial ability to take risk, you will be better able to deal with the volatility that will certainly come to you in the course of this bull market. The last thing I want to say is that you need to have a selling strategy or a variety of selling strategies. I asked myself some time ago, what would cause me to sell my gold? What would cause me to walk away? And what that would have to do with was an unwinding of the circumstances that caused me to buy my gold. Specifically, for me, I would need to say that there was no further need for quantitative easing. I would need to see a balanced or nearly balanced federal budget. I would need to see a rational plan for servicing the net $30 trillion in on balance sheet obligations confronting the US taxpayer. I would need to see a politically feasible plan, uh, other than the devaluation of the dollar, to deal with the $100 trillion in net present values of unfunded government liabilities, Medicare, Medicaid, Social Security, federal government pensions, military pensions, and the like. And I would need to see a positive real interest rate. And let me describe that a little bit. The US 10-year Treasury pays about 4.5% right now in a currency that I believe is experiencing a loss of purchasing power at about 7.5%. The idea that I get paid 4.5 in a currency that's losing 7.5 means to me that if I own the US 10-year Treasury, I'm losing 3% a year compounded for 10 years. Hardly a good deal. In order for me to say I was receiving a positive real interest rate, the interest rate on the 10-year Treasury, the world's benchmark savings and investment instrument, would have to be 100 or 150 basis points above the deterioration of the purchasing price of the US dollar, which is to say a 10-year Treasury yielding something like 9 would work for me, unless the underlying rate of deterioration of the US dollar fell. Putting that 9 in context, that would suggest a prime rate in double digits. It would suggest a 30-year fixed mortgage in the range of 12. A set of circumstances that would be very difficult to confront in today's economy. I lived through the last time we did that, the decade of the 1970s. In the 1970s, the prime interest rate went up almost fourfold. And it was an ugly, ugly, ugly set of circumstances. Although by the end of the decade, we had dealt with inflationary expectations. We had dealt with an awful lot of things. It is my personal belief that past is prologue. In the decade of the 1970s, the purchasing power of the US dollar declined, according to the Congressional Budget Office, or its predecessor, by 75%. And my suspicion is in the next 10 years, the purchasing power of the US dollar declines by 75% in absolute terms. Again, if it were, that is to say, if the purchasing power of the US dollar declined by 75%, we would deal with the net present value of off-balance sheet obligations by in effect devaluing them. And that's the way that I think ultimately we're going to have to deal with them. This is all very bullish with gold. You have to understand these arguments and agree or disagree. And you need to think through how you're going to participate in the bull market. You need to think through, too, how much risk you're willing to take, where you're going to be on the curve, and how much of your net worth you're going to risk on being right or being wrong. Let's revisit the first statement. God, please give me one more bull market, pardon me. I promise not to waste this one. We're in one now. Don't waste it. I think that's what I had to say to begin with, Albert.
Joining us, we are at ruleclassroom.com. We do this every week with Rick Rule and other experts. You can go to ruleclassroom.com. Membership is free. You get access to a real treasure trove of past live stream archives, as well as courses on natural resource investing by Rick Rule. Rick, let's get to some of these questions because they're coming in really quick. Diane is from Quebec. She's asking about Africa Oil. The change in the name, Rick, as a result of a transaction. Can you just elaborate on what happened there? Marin Energy is what I see.
Yes, the African Oil Lundin-backed vehicle acquired their joint venture partner, a private oil company, and consolidated their interests in the Nigerian offshore. As a consequence of that, the Lundin family are no longer the largest shareholders in Africa Oil. And some of the business plan of the company has changed. In particular, distributions to shareholders, the distribution of capital, will be much greater in the future, either by way of dividend increases or buybacks or both. The company is now generating enough cash that they can at once exploit the offshore exploration potential of their Nigerian assets, something that they haven't done until now because they were paying off the acquisition debt, and participate, if they want, in the offshore Namibian frontier province where they are, while simultaneously returning large amounts of capital. Given that the business focus and the leadership of the company has changed, I suspect they've changed the name. I continue to be a shareholder. I continue to believe that at $60 oil, Africa Oil is selling at about half net present value, which is very attractive to me. Personally, I would prefer that rather than increase distributions for shareholders, that they were more aggressive exploring their Nigerian assets. Mercifully, for those of you who like dividends, the company is highly unlikely to listen to me.
Okay. And why is that, Rick? Why aren't they listening to you?
Some of the shareholders of uh, the company that was acquired were private equity firms. And I suspect that they have partnerships that are unwinding. At any rate, the agreement between the new shareholders and the Lundins was that the pace of distribution to existing shareholders, the return of capital, would now increase. The first challenge was, of course, to pay down the acquisition debt that they incurred when they bought the Petrobras Nigeria assets. They've done an amazing job of that while maintaining and, in fact, increasing sustaining capital investments in Nigeria and participating in discoveries in other basins. But the new majority shareholder has decided that now that the debt has been paid down, that it's time to increase distributions to shareholders. The shareholders have been, in effect, stuck in these assets for 5.5 years, and they'd like their money out.
Okay, we got two related questions. Bill and Dave, both interested in uranium. Rick, your thought on the status of uranium equities in general, and then in particularly, Dave is asking about your ranking on Homeland Uranium.
Homeland Uranium, although I'm a shareholder of, I don't have a ranking yet. It's too early to say how they are going to proceed. And until I have more history, I don't have a ranking on them. Note that I am a shareholder. I know the management team well. I know one of the assets reasonably well, and I'm not unattracted to the U.S. uranium business, particularly when the size of the prize is large. And this is a pretty good deposit. So this is also a very speculative stock. So don't own this one if you aren't prepared to take real risks. Look closely at it if you are prepared to take real risks. With regards to the uranium market, it has a lot to do with how you see the market, how you see yourself as an investor and speculator. We talked in the Rural Classroom here 3 or 4 months ago about the amount of hate that the junior uranium sector was experiencing and how there was a real good snapback trade coming. If you bought the junior uranium stocks as a consequence of the fact that they were oversold, you're up 30, 35, 40% on your money. If you're a trader, you might want to take some off the table. If you bought because you were expecting a snapback, and by the way, I bought expecting a snapback, the stock that I bought expecting a snapback is in the process of being sold as we speak. The majority of my own uranium shares, about 80% of my portfolio, I'm likely going to own for 4 or 5 years. I see the structure of the uranium business fundamentally changing. People who are interested in uranium, by the way, should revisit the uranium boot camp that we did. Yes, we did it several years ago, but 95% of the information in that boot camp is extremely timely today. What is changing is all beneficial, and that is this. The structure of the uranium business is changing from a spot market where prices between buyers and sellers are determined in an overnight market to a term market where prices are set contractually for periods as long as 20 years, adding certainty to both the buyers and the sellers around the quantity of uranium traded and the price at which it is traded. This certainty allows smaller companies that wouldn't otherwise be able to finance projects into production to, in fact, finance those projects into production, because they can use the contracts with credit grade counterparties to reinsure the banks and the lenders about the stability, at least, of their revenues. It also allows lazy securities analysts, guys like Rick Rule, to be able to forecast top line revenues much more accurately and to be able to forecast margins more accurately than they would otherwise be able to the extent that we have access to the information in the term contracts. That's a very long-winded way of saying if you are a trader and you bought the uranium because it was hated, you might want to take some money off the table. If you're an investor, there's much more to come.
Rick, did I hear you correctly say 80% of your portfolio consists of these stocks?
80% of my uranium portfolio.
Okay, thank you.
No, 80% of my uranium portfolio.
Yeah, thank you very much. Okay, question coming in from Cohen about Meridian Mining. Seems there was a recent feasibility study, Rick. He asked, what's your opinion on the metal price assumptions in that study and your current ranking for Meridian?
I haven't had a chance to review that feasibility study, so I have no opinion.
Okay, from Zolt, is Ivanhoe Mines a contrarian opportunity now?
That's a wonderful question, Albert. As you know, I threw out an invitation today to Robert Friedland to come on the classroom. He decided not to do that as a consequence of some pending news at Ivanhoe. The problem is serious. There's, underground seismic stability issues. We don't know anything right now. We do know that the company made the right decision, which is to say they evacuated all their workers from the mine, putting human safety above near-term profitability. We don't know anything about this. So in the near term, we can say nothing. The market's reaction has been vicious, selling off 30, 40%. I would remind investors that this deposit has a 40-year mine life, and a resolution of this problem likely takes place within 6 to 9 months. If you are looking at the deposit the way I am, which is to say receiving revenue from it from the rest of your time on Earth, what you try to determine is the period of maximum pessimism. I don't think we're at the period of maximum pessimism right now. We've had a pretty good shake, such a good shake that they are diverting capital and people to the Kamoa side of the deposit. And they're experiencing flooding now in the Kakula side of the deposit. So after they determine, or concurrently with determining the nature of the seismic event, they're going to have to dewater the mine, even while they worry about how to shore up the pillars and the roof. So this is a situation that won't resolve itself for at least 6 months, I would suggest. We may know how we're going to resolve it, but we won't have it resolved for 6 months. So there's lots more time for mischief. I will almost certainly be adding materially, I mean really truly materially, to my Ivanhoe position. What I've learned is that when there are one-off events that cause the price of an asset I want to own to decline precipitously, at some point in time I need to act if I believe that they're one-offs. I believe that it's likely that the underground development at Kakula was too aggressive, that they made very aggressive assumptions about the stability of the deposit and the size of the crown pillars that they needed to make to hold up the walls, which is to say, I believe they probably removed too much material and didn't use enough, if any, backfill. And I believe that in the future, as a consequence of that, that mining costs will have to go up, that you'll have to spend more money on support, that you'll have to leave more ore in place, that you will have to put more material back underground as paste, as fill. And I don't have any reason to say this, except the fact that I've watched circumstances like this over the last 40 years, and that's usually what happens. This is one of the best copper deposits in the world. This is the highest grade big copper deposit in the world. Has a long way to go. There's lots of exploration upside. I suspect that this is a one-off event, but I don't suspect that this is a one-off event that has already caused all the mischief that it's likely to cause.
Yeah, that is the nature of engineering, right? You push aggressively and then you pull back when you've gone too far. Rick, you mentioned about not being at the state of maximum pessimism and that you want to add to your position. But I would imagine that trying to pick the point of maximum pessimism is like trying to pick the top. So how do you approach this? Do you approach this any differently? Like, shouldn't you be averaging in or something like that? How are you going to?
First of all, I assume I'm going to get it wrong. But when I start seeing lots of analyst reports recommending a sell, that'll be a good sign. Bernard Baruch famously said, the only guy who bought at the bottom and sold at the top was a liar. It didn't happen. And I will miss the bottom, almost certainly. I'll buy too soon or I'll buy too late. But you don't need to get the tops and the bottom. You just need to cut a big fat slug out of the middle. And that's what I hope to do.
Okay. David's interested in silver, wants to know about two names, Discovery Silver and Ivanhoe Silver. Just your comments and if a rating, if you have one.
I own Discovery Silver. I have Discovery as a 5 as a consequence of recent market strength. Discovery Silver is becoming less of a silver mine and more of a mine developer. They had an interesting silver deposit and have an interesting silver deposit in Mexico. But what attracted me to the company is the track record of success around mine building enjoyed by the management team. I've known them for 30 years, watched them build a lot of value at various places. Very recently, of course, Discovery Silver, backed by Albert, our old friends at Sprott Capital Partners, SCP, and others, bought a mine in Ontario as part of the Newmont disposition. And they have vaulted now, or are in the process of vaulting from being mine developers to mine operators. The idea being that they will utilize the free cash flow from the Ontario operation, to pay down the debt associated with that, but also to fund the Mexican asset in production to grow the company over time. With a lower quality management team, I would probably be nervous about serving two gods, trying to do those things simultaneously. I have known this team for a very long time, and I think it is a good speculation as opposed to a certainty that they'll be able to pull this off. I also am a believer in higher gold prices and later higher silver prices, and I suspect that those will inure to the benefit of the company. With regards to Ivanhoe, I know it less well these days. My criticism of Ivanhoe was always that it was a high quality mine, but a small mine. And I have a prejudice against small mines. Both big mines and small mines have big risks, but small mines make you small money, while big mines can make you big money. And I like pro forma to take big risks in return for big rewards. The Ivanhoe people have been in Mexico for a very long time. I've known the Wolfen family for almost 50 years. They have been operating in Mexico for almost 50 years. They know they're part of Mexico very well. My understanding is that in addition to the legacy Ivanhoe mine, which, by the way, has been in production since the 1500s, that they have 4 other projects that they have acquired that they would like to put in production in the next few years. When I have a chance to get to know Ivanhoe better again, it may be that I'll be able to overcome my objection, my small mine objection. But at present, I don't own Ivanhoe. And at present, I have it as a 6.
All right, Rick. I want you to elaborate on that a little bit. All rules have exceptions. So the exception to the small mine rule would be what?
If there is enough operating synergy between the Ivanhoe mine and the mines that they're going to put in production, as an example, common processing facilities, where 3 or 4 mines put together, 3 or 4 small mines equals 1 big mine. Small mining per se is very tough. I have probably invested in it or speculated in it 15 times in my career. I made money with Glamis. I somehow conspired to lose money with Mandalay, which is tough because the stock did very well. I just traded it poorly. But the fact that I've had so few successes in 10 or 15 tries, that tells me that I'm better off staying with my own mantra.
Right. But this sort of cumulative benefit could occur as a result of an M&A, right? Anticipated M&A.
And a lot of other people aren't troubled by that. In a bull market, all ships rise. And it might be that the generalist investor, when he or she comes into the precious metal space, doesn't care, big mine or small mine. They are looking at production, they're looking at margin, or they're just looking for a narrative. It is very true that in the later stages of the bull market, the lower quality companies do better than the higher quality companies. I've learned for myself that when that begins to happen in spades, it's time for me to exit the space, but that's a different question.
Right. And if you're interested in that paradox, I think Rick and I have had discussions about that marginality in the classroom in many videos. Rick, interest online in Cerro de Pasco. Jay wants to know, is this a 10-bagger opportunity? Antia asks, what is your opinion of the management?
Well, first of all, I own Cerro de Pasco. I've known these people for a long time. One nervousness I have is that this team isn't as experienced in South America as I would prefer, although they are experienced in South America. Cerro de Pasco, for the people who don't know, is a historic mining district in Peru, one of the 10 biggest silver mines by cumulative production in the world. And the new incarnation, Cerro de Pasco, a Canadian listing, proposes to retreat the tailings from 500 years of silver production. The silver contained in the tailings would make it one of the largest silver resources on the planet. That's the rock that's left over from prior processing. Interestingly, you don't have to mine this stuff. You basically dredge it, regrind it, and take out the silver that the Spanish missed. This project hugely leveraged to process and technology and hugely leveraged to the silver price. When the questioner asks, could this be a 10-bagger? The answer is yes, as long as you give me access to the word could. This is hugely leveraged to higher silver prices, and this is also hugely leveraged to management's ability to handle grade and metallurgical variability in the tailings deposits, where the deposits themselves aren't homogeneous enough that you can understand them easily. There are tailings recycling operations, in particular in South Africa, but also in Chile, that are horrendously profitable. I mean, ludicrously profitable. I'm hoping that Cerro de Pasco is one of those. If it is, given the size of the contained resource, a lot of money can be made, but a lot can go wrong.
Okay, let's go back to David. David wants to know about Next Gold, Rick, comment and rating.
I don't know enough to comment, so I'll pass on that one.
Okay, what about Sierra Metals?
I looked at Sierra Metals. I have a 6 on it. Certainly, their promotional acumen is fantastic. The attributes that some analysts see in Sierra have escaped me. Decent people, decent deposit. I want to be better than decent.
Okay, yeah, a question about GoviEx, Rick. It's something that we haven't mentioned in a while, but David says there's some activity lately. Any comments on GoviEx?
GoviEx will be an interesting speculation on higher uranium prices. GoviEx principal asset is a wonderful deposit in the country of Niger, which is undergoing a lot of political and social change. The mineral tenure enjoyed by GoviEx in Niger is one that's in flux. It's difficult to analyze because you have no idea politically and socially how that's going to play out. They have a second deposit, which on the face of it looks fairly attractive in Namibia. I'm not sure how they managing the development, not Namibia, I'm sorry, Zambia, how they manage the exploitation of the Zambian asset, while at the same time, they manage the retention of the asset in Niger. I have a huge amount of time for the Friedland family, including Govind, Robert's son, but I don't own GoviEx.
Okay, Patrick's commenting on the recent aggressive deployment of capital by Franco, Rick. He identifies streams and royalties. What do you think about these transactions?
The Franco people, similar to myself, believe that we are in the early stages of a precious metals bull market. Obviously, they think that that bull market extends to platinum and palladium too, with the Sibanye-Stillwater transaction. This is a time to participate, even at premium prices, with high-quality deposits, which is precisely what they're doing. Note that Franco has an amazing amount of firepower, not just the cash on hand, but also enormous free cash flow and enormous untapped credit lines. Franco has the ability, should they choose to do so, without going to capital markets, of deploying $3 billion as we speak. I've been on record at the Rural Classroom as saying that there is a potential right now for very, very large royalty and streaming transactions, particularly around providing development capital for large copper deposits that have gold and silver byproducts, or funding the acquisition, partial acquisition by host governments of very large deposits in their territories. These could be financed in some way, shape, or form by royalty and streaming agreements. And I think one of the knocks around Franco-Nevada and Wheaton Precious both has been that people believe that their growth in the future will be slower than it's been in the past. These recent deployments by Franco and the opportunities around financing copper production or political acquisition by societies of large deposits in frontier markets suggest that these companies will be able to grow as fast in the future as they have in the past.
Okay. Let's see. Familiar name, Josh, asking about First Mining Gold, Rick.
Don't really have a comment on First Mining. Good people, okay deposit. I don't own it. At this stage in the market, I want to buy high quality stuff. This is the kind of stock that in a gold bull market will scream, though. These people know how to access a broad audience. They are perceived, being in Canada, not to have any political risk. I, of course, would argue with that, given who the Canadians elected as prime minister. That notwithstanding, in a gold bull market, facts don't matter much. And there will come a time in this bull market where First Mining absolutely will scream.
Okay. Rick, do you follow Fireweed Metals in the Yukon?
I am a Fireweed shareholder, and I have it as a 4. I've known these deposits my entire adult life. They are absolute tier 1 deposits, but they are in the middle of nowhere. I mean, you take a long helicopter flight from nowhere to get to these deposits. These are really, truly remote deposits, but they're world-class deposits. They are ultimately controlled now by the Lundin family, who have the ability to be very patient, who have the ability to raise the money to drill off what are already huge deposits in undeveloped locations and finance them into production. Owning Fireweed is not for somebody who wants immediate gratification. Owning Fireweed is for somebody who wants to buy 2 tier 1 deposits, perhaps 3, in one wrapper, and is content to watch his or her investment grow in fits and starts, but dramatically in the 5 to 10 year time frame. Despite my advanced age, I'm still one of those.
Okay. Dave wants to know, are you still loving gold royalty?
Love is the wrong phrase, but I like it a lot. Higher gold prices really, really, really help the 22 odd deposits that Gold Royalty has a royalty on. They also have a very aggressive and transactional management team, meaning that they have the ability to add value to deposits that very few royalty company managements do. The company is the brainchild, of course, of Amir Adnani, who I think is one of the absolute up-and-comers in mining finance. In fact, he will be one of the subjects of the 2026 Natural Resources Investment Symposium. When we look at finding the next generation of living legends, the next generation of leaders, Amir Adnani is one of those. I like the royalty model, as you know, Albert. I like Amir Adnani, and I like the impact of an aggressive management team beneficiating their portfolio holdings rather than merely being passive participants.
Okay, question from Guillermo. Rick, what do you think of NextGen's exploration results on Patterson Corridor East?
They are excellent exploration results. The truth is that a deposit is large enough that they don't need it. But the fact is that it's going to be a long road to production. And they have stated for a decade that there was lots of exploration upside there. If there is a lot of exploration upside, and these results suggest there is, they were sterling results, probably it's something that you should be doing. The market may not care because they have enough uranium now. The market is concerned with when they put it in production. But the truth is, right sizing the upfront capital investment, taking into account the size of the deposit, is something that you do in engineering a uranium company. To me, I'm considering this icing on the cake. The market doesn't care about the exploration results. I get to take it into consideration, and I get to consider in the fullness of time how I value it, while other people pay no attention to the information at all.
Okay, let's switch gears a little bit, Rick. Michael says a few weeks ago you mentioned that you were looking at banks. Are you able to share any thoughts on that?
I like what I see. I'm not going to name any names because there's 2 or 3 community banks, fairly small banks, that I'd like to become a shareholder of. And I frankly don't want competition from 3,000 investors listening to this podcast. These are fairly thinly capitalized banks, and I need to be able to buy those shares carefully. I am, as virtually everybody listening to this broadcast knows, also part of starting up a bank called Battle Bank. I hadn't realized at the time that we started Battle Bank that the name meant battling to start a bank, or battling to get regulatory approval to start a bank. But I love the banking business. I'm really attracted to the banking business. In fact, Albert, you and I were involved in a conversation today around Battle Bank, which I think will air fairly shortly. And we're going to do a teach-in effect. I'm going to do a teach-in with Frank Trotter about the economics of banking. If my memory serves me well, that will be on June 6th at 12:30 p.m. here at the Rule Classroom.
Okay, let's go back to Jay, who's asking about Chalice and Bravo. He's saying seems to require palladium at 1700. Rick, your thoughts on that? And then as far as the opportunity goes, what are your thoughts?
I am a small Chalice shareholder, and I'm a large Bravo shareholder. The Chalice deposit is huge, and it's conveniently located quite close to Perth in Western Australia. The Bravo is a much higher grade deposit located in Brazil. I am attracted both to nickel and platinum and palladium for different reasons. And I'm attracted to sulfide mafic and ultramafic deposits generally. So I own both of these, but in different sizes. I own Bravo, particularly because of the exploration upside. The deposit is of decent grade. I believe, as it stands now, it would be in the lowest cost quartile worldwide. But I believe that the primary deposit can double through exploration. And there's a new exploration thesis around iron oxide copper gold, which is to say a separate deposit type on the same property. So I would consider myself, Bravo, to be more of an exploration stock than a platinum and palladium or nickel stock.
Okay, let's see. Diane's asking about COSA uranium. Rick, any comments on that?
Don't have enough knowledge of COSA to comment.
Okay, let's see. Let's see. Have we talked about Sierra Metals? I think we have, right?
You did, yes.
Yeah, we did. Okay, let me see. Let me go see if I can find some more questions here. Talking about some politics here. Rick, while I look through these, let's talk about the symposium, because we got about 15 minutes left here. And we've talked about it. Obviously, we're just over a month away, so we're talking about it a lot. But one thing we haven't talked about is what people are going to learn from you. We've talked about David Stockman, Nomi Prins, James Rickards, Danielle DiMartino. Grant Williams, so many great speakers. But this is a mining audience, Rick. And we have several experts who are going to be there talking precisely about mining specifically, and none other than you yourself. So, Rick, what can people expect to learn from you during this 4-day event in Boca Raton?
This is going to be how-to. Prior to last year, the two conferences that we did before, I was just trying to talk people into the fact that we were going to have a bull market. And the way to get into the ground floor was to get in the ground floor. We were successful at doing that. People have made a lot of money at our conferences. We're in that market now, at least with regards to precious metals. So I don't have to talk you into the fact that gold can go up now. Now I have to talk to you about how to make money in the market. I have to talk to you about specific companies. I have to talk to you about how to buy it, how to sell it, how to manage your emotions during it. I need to talk too about what I consider to be an incipient industrial materials and energy market. My belief is that whole sector gets cheaper because I believe that we're in the early stages of an economic recession. In a recession, demand falls, and prices, even in the face of shortages, can fall too, as we've seen in the oil price. This masks a dramatic shortage 5 years from now, 6 years from now, 7 years from now, in a lot of commodities. And I think a discussion of how one pays attention to two bull markets, a precious metals bull market and a natural resources bull market, is what I'm going to be all about. I'm also, Albert, for the first time in 3 or 4 years, going to talk more about speculations. We are coming into the market now where the generalist investor is going to come into the space, but they're going to come into the biggest and the best. And there's going to be large valuation discrepancies between the biggest and the best and the rest. And there is also going to be, I think, an orphan category where you find companies that have very high quality deposits in out of favor commodities in out of favor countries. And finding tier one deposits in out of favor countries, in out of favor commodities, and being willing to take the political risk, the market risk, the financing risk. That's where 10 baggers come from, 20 baggers come from, 30 baggers come from. So in addition to encouraging responsible investing, which I've done for the last 3 years, I'm going to start talking about aggressive speculation, which is, of course, how I made the money that I now invest carefully.
All right, let's get to a few more questions before we have to call it quits, Rick. But I'll just mention there is the link, symposium.rulclassroom.com. You can attend in person or online.
I should tell folks the price goes up tomorrow. So whether you want to attend in person or online, today is a very, very, very good day to do the trade. The price goes up tomorrow. Of course, whether or not you attend online or in person, if for any reason you don't feel that we've given you full value for money, you can exercise a 100% refund policy. If for any reason you fairly don't believe that we've delivered the value that we've offered you, we'll give you your money back. And today would be a wonderful day to do that, given the fact that tomorrow you'll have to pay me more than you would today.
Okay, I did not know that. Okay, let's get through a few more of these questions while we still have time. Rick, Chris is asking about Pan American Silver and Dolly Varden.
I own both. I need to say I've sold enough Dolly Varden. It's done spectacularly well since they debuted at our conference 3 years ago. I've sold enough Dolly Varden that I no longer have any net cost in the rest of my Dolly Varden, that wonderful point of no concern trade. Pan American Silver, I go back with a long time. In fact, I was a founding shareholder of Pan American Silver. And I think that they're at a fairly sweet spot right now. They recently acquired MAG Silver. They paid a very full price, but they paid a full price for an absolute tier one asset. They bought a minority interest. Most people don't have the courage to buy minority interests, but they bought a minority interest in one of the finest primary silver deposits in the world. One where there is a lot of development upside and a lot of exploration upside. The majority partner in that, Fresnillo, has shown a lack of willingness over 40 years to explore the exploration potential of the district, which is how MAG got involved there to begin with. They just staked the on-strike extension of the Fresnillo silver mine, the biggest silver mine in the world, which says something about the exploration aggression of Fresnillo. Pan American will address that. In Pan American, I get two other assets, potential assets, for free. There is an asset in Argentina and a different one in Guatemala, each of which contain over 500 million ounces of high-grade silver. For political reasons, neither of those are in production. If, notice I'm not saying when, if Pan American is able to bring either of those two into production, their primary silver production doubles. It's very seldom that you see a company of Pan American size with Pan American's financial flexibility, balance sheet, and income statement that has the ability to double production, never mind double production twice, from reserves and resources which are already controlled in the company.
Rick, got a question about the conference, which I can answer. Column asked, is virtual live stream access going to be rewatchable for the symposium? That is a yes. Whether you're online or in person, you have access to the recordings after. And I actually sometimes, even though I'm there, Rick, I like to watch the conference via live stream from my room because it's just so comfortable. So that's a great benefit. And Rick, one time you mentioned how much content we have at the show, and I got an email from someone saying, sorry, Albert, that's impossible. There's no way you have that much content. It just doesn't work out the math. But keep in mind, we have concurrent sessions, 5 at a time in the afternoon. So there's a lot of material, and it's physically impossible to take it all in. So yes, that's what the recordings are for. Anything to add?
I was going to say, try me. We often have 4 breakout sessions simultaneously. So during that morning session and the afternoon session, every hour equals 4 or 5 hours. The truth is that we'll have between 50 and 55 hours of programming over 4 days. I put on the conference. I produce the conference. I'm responsible for selecting a lot of the content and curating the order of that content. And I have to watch the tapes. I have to watch the recordings. And I'm supposed to know all this stuff, just like I watch our boot camp tapes, Albert. The truth is there's only so much information that you can absorb if it's high quality, dense, valuable information.
That's right. That's right. So yeah, that's a yes. And let's just get through the rest of these. Zolt had a follow-on question to his early one that we didn't get to, and that is Rick's take on Exxon's asset selling in France.
It's a distraction, first of all. It isn't a big business for them. And France is a challenged market. Socially and politically. I don't think that Exxon sees France as a growth market. I think Exxon would rather redeploy the capital that they have tied up in France in markets like South America and frankly like the United States, where their business is growing more rapidly. I support the decision.
Okay, Josh asks your thoughts on Erdene Resources, Rick.
Erdene is a company that I don't own, but I like their exploration tenor. For those of you who don't know Erdene, it's a company that's aggressively exploring. They have 2 indicated discoveries, size uncertain, in Mongolia, which is real, true frontier exploration. There have been a couple world-scale discoveries in Mongolia, in particular Oyu Tolgoi, one of the 5 biggest copper mines in the world. And Erdene has been in the country for a very long time. They're not Johnny-come-latelys. They're 20 years in country now. So I'm favorably disposed, although I don't own them.
Jim has a good question that a lot of people ask. How do you know when to get out of a mining stock in a bull market? 5x, 10x, 15, 20?
I always get it wrong,
But you get it wrong, but you must have some method still, right?
Well, listen, here's one thing. We're coming into a bull market that's going to surprise people. They've been conditioned through years of not so good markets to have very, very, very conservative expectations. You'll recall, Albert, in our exploration boot camp, I said that one of the things that you do is you have a reason to own a stock. You anticipate the answering of an unanswered question. You try to figure out what a yes answer is worth, and you try and figure out the probability of the yes answer. What will happen in a bull market is that you won't have to wait. You'll get the performance that you hoped to get if you get a yes answer before the question has been answered. In those circumstances, you sell. Maybe not sell all, but at least sell enough that you have taken the money off the table. 3 years ago with Dolly Varden, I believed when they made the acquisition of Homestake Ridge that they were going to have the critical scale to come to the market's attention, that there was exploration upside both at Homestake Ridge and down in the valley, and there was some possibility that they were part of one mineralizing event and they would join up. The unanswered question was, will they be able to exploit that exploration potential, and will they get some sniffs in the middle? The answer was yes. The stock tripled. A triple in the stock was my goal. When I realized that goal, I sold some stock. I didn't sell it all because I recognize that there is a new unanswered question or several new unanswered questions. But the truth is, by selling, I gave myself the ability to take all of the risk out of the transaction from my own point of view. It's important to note that money is made on the delta between what something is priced at and what you think it's worth, and then what you think it might be worth upon the answering of an unanswered question. As those questions are answered, you need to do the same value versus price calculation that you did. I would urge the questioner to review the section in the Rural Classroom called Introduction to Natural Resource Investing. We cover this issue, and we cover this issue for investment grade companies and speculative companies, and we cover it very thoroughly.
Yeah. Bull market, sometimes Santa Claus comes in September when there's no snow on the ground. That's a good hint. Okay, Manu asks, any thoughts on San Lorenzo gold, Rick?
No, sir. Don't know enough to comment.
Daisy wants to know what you think of Western Uranium.
As we go through this greatest hits, I would tell the speculators that what I think is less important than what they think. And I would urge everybody asking questions around these companies to review the lessons in the Real Classroom. My opinion can change a week from now based on news. And you're going to go on what you thought my opinion was before the news changed without yourself being able to change with it. I will humor people. You've heard this joke before, Albert. If you're Rick Rule or Doug Casey or something like that, you think your job is to teach people how to fish. What people want is for you to catch the fish, clean the fish, fillet the fish, prepare the fish, and serve it up with suitable garnish. So I don't own Western Uranium. I think it will be a beneficiary of the more positive narrative around U.S. uranium, but I don't like the size of their deposits particularly. I like world-scale deposits, and it doesn't make it from that point of view. That doesn't mean I don't think the stock will do well. I think the stock will do very well, but that isn't enough reason for me to own a stock.
Okay, and with that, Rick, we are out of time. So I just want to remind people, new interviews every week at rulclassroom.com, as well as all that material in the classroom archive. Symposium, just over a month away. Go to symposium.rulclassroom.com for registration information. And then we will be back next week on the Rule Investment Media YouTube channel with a special Battle Bank update and a live Q&A with Frank Trotter. So look for that next week. Rick, thank you so much again. Any parting words for the viewers?
Yeah, absolutely. The Symposium is financially riskless. If you don't think you got your money's worth, I'll give you your money back. And the price goes up tomorrow. This is a no-brainer. I look forward to seeing people in Boca Raton or via live stream in the comfort and convenience of their own home. Remember, we have a bull market coming. In fact, we're in a bull market. We have a second bull market coming. Learn how to play it. Get in the game.
All right. Thank you. Thanks, everyone, for your great questions. We'll see you next week.